There you are. Hello, Paul. How are you doing?
Good afternoon, Theo. I'm very well, thanks. How are you?
I'm very well. Thank you. Thank you. So, looks like another interesting session today. Yeah, how to trade a three-bar reversal with price action. Uh,
Yep, just a very nice, simple, mechanical, price action based trading strategy that traders can take on board, set away, go away and utilize in their own trading. So
oh,
just nice and simple, work
absolutely.
well for them.
Absolutely. And can it be used also on a lower and higher time frames? Yeah,
Yeah,
everywhere.
so
Perfect.
we'll find that it works across all instruments, all time frames. So that's fabulous. It gives everyone a real boost. So regardless of what they
Yeah.
particularly like to trade, they can utilize that. They can effectively take it on board and then utilize it in their own trading. Take it forward with that.
Awesome. Awesome. So, looking forward. I'm sure everyone will be excited and waiting to learn how to trade a three-bar reversal. So I wish you best luck. And
Thank you.
I'll talk to you soon. Yeah,
Excellent.
perfect.
Fabulous. Thank you for the introduction, Theo. Good afternoon, everybody. I hope you're well. I hope that you can hear me okay. I hope that you can see the slides, and I hope that you are ready for our session today. Another price action session, and in particular, what we're going to focus on is how to trade what I would determine as a simple three-bar reversal, which is just a very simple price action setup that those of you who are new to your trading journey, those of you who've been trading for a while, and hopefully utilize in your own trading. So remember, here we are, Admirals, a broker with a global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing you the opportunity to engage with markets utilizing both the MT4 and MT5 platform. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. Well, not unsurprisingly, we're talking about price action trading as always, but primarily we are going to focus on a very simple mechanical setup called three-bar reversal. We'll talk about on the charts and in particular, okay, what is the best way for us to trade them? And I'll share with you my own experiences with that. So hopefully you'll be able to take this little setup away and utilize it in your own trading. And we'll have a little look at the live markets based upon the time we have at the end. So make sure you stay to the end. As always, we're always a little bit crushed for time because I'm always trying to share as much as I possibly can with you to help you in your own particular journey. And as always, I recognize that we have a truly global audience here who join us. So it's great to see people from all over the world joining us there. See Teresa saying there, good morning from Mexico City. It's absolutely fabulous to have you here, Teresa, and everybody else. Okay, we here at Admirals, wherever you are in the world, we hope you're having a good year. We hope that you're enjoying these interesting markets, and we thank you for joining us. And I also recognise that we have a great range of experience of people who join us for our sessions, from complete beginners to intermediate and advanced traders. There will be something, as always, for everybody. And I'll share a couple of my own thoughts and ideas, and hopefully it can all help you on your own trading journey. So for those of you who don't know me, my name's Paul, traded for many years, traded for funds, traded for clients. Primarily, I like to trade FX indices and commodities, and that's what I'll be sharing with you today, definitely. And I like to trade trends for longer term trading, and I normally trend reversals for shorter term trading. But today, I'm just going to share with you a little bit of a reversal setup that actually is allowing you the opportunity to join an existing trend as the dominant trend re-emerges. Hopefully, this will put you in a position to be able to take advantage of that. So, we've done lots of the price action sessions now, and I'm hoping that those of you who've joined us, and whether you've joined us from session one or if you've joined us along the way, you've realised that what we're trying to do here is to recognise that we understand that sometimes for new traders, it can be somewhat intimidating overwhelming with the amount of data, okay, and resources that are available out there. And what we've always wanted to try and do with these sessions is just recognize that with a little bit of education, a little bit of understanding of price action, how candlesticks are formed, what they're actually telling us, then you can utilize that data to analyze and understand the markets. So each Wednesday, we've just been trying to build up from our previous sessions so that you're educated and informed how to use price action in your own trading. And you can see for yourself there, we have covered an awful lot in our sessions. And I say it every week, I try to cover the hard skills and the soft skills of trading in the full sessions. And I appreciate if you're a completely new trader, you might be you might not necessarily fully understand the kind of the importance of the soft skills, things like preparing for opportunities, building routines, having checklists, grading your trades, reviewing your trades. But I assure you, as someone who's traded for a long time, it's those soft skills that are what makes traders develop into being the best version of themselves as traders, and that's what I would like for all of you. And the other good thing is that all of these sessions have been recorded. They are all on the Admirals YouTube channel and Facebook channel. So be sure to, to sort of find them there if you either missed a couple of sessions or if you, want to just recap a couple of the elements to just, solidify your own learning. But today is all about 3-bar reversals, and we'll crack into that in a couple of slides' time. What I have also during these series is just I wanted to effectively, every week just reinforce having a very simple, basic plan and routine that you can follow, okay, that will help you with price action trading, just help you in trading generally, having a good routine that you can follow. And we've gone through these. Step 1, whenever you open a chart, okay, whatever you trade, Bitcoin, gold, euro, dollar, whatever it is, first thing you should be doing is defining levels of support and resistance. Start the monthly, down to the weekly, down to the daily. Get those levels drawn in. Then what we're looking to do is see is there a trend in place? And I say it every week. Okay, good trends leap off the chart. All right, you don't need to force it. If you are finding yourself forcing it, or if you don't know, it probably isn't a trend. Good trends leap off the chart. The challenge we have is that they only trend for about 20 to 30% of the time. But if they are trending, if you find one that is trending, well, ideally what we're looking to do is in an uptrend, we want to look at opportunities to buy on pullbacks. And if price is in a downtrend, we want opportunities to sell at rallies and when we get to reach resistance. And so step 3, we're looking to see how does price react at those key levels. Those levels might be the support and resistance levels that you've drawn in at level 1. Step 1, they might be big round numbers, big psychological 000 numbers like 2000 in gold or 2000 in the Russell, like we've had recently. Because what we want to do is to see as well, look for price. How does price react? Because step 4 is we're looking for price action signals at those levels. Price action triggers, so things like pin bars, engulfing candles, key reversals, star formations, inside bars, those hard setups that most new traders focus on, most new traders love to look at, but this is about putting that into a wider context, okay, into a wider context that allows you to analyze markets and also sort of choose the best opportunities. And step 5 is it part of a bigger chart pattern? Have a look. Is it part of maybe a continuation pattern, like a flag pattern, or maybe it's into a reversal pattern, like a double top or a double bottom? Just sometimes, new traders get very, very, super focused on, trading a pin bar. And actually what we want to do is, they lose the ability to see the wood for the trees, as we say here in the UK. And it sometimes you just need to step back and just see, is it part of a bigger chart pattern? And then we have the what I would call the 5 R's. All right, these are things that you should be doing. Okay, all good traders are doing. Step 6 is risk. Okay, make sure that you accept the risk involved and you manage risk, and that means never trading without a stop loss, only risking a small portion of your capital on one trade. The flip side of that, step 7, is the reward. Okay, should the trade work for us? Are we going to have a target that we're going to work towards, or are we going to trail or stop until we are trailed out? The important thing is that you choose before the trade goes on, not sort of changing tack as the trade goes on. Step 8 is records, okay, and we, insisting on keeping great records, okay, keeping great records, a spreadsheet of your trades and also a journal of actually, how you've managed yourself during those trades. Because when we go on to step 9, well, that's about reviewing, all right, review your trades, okay, go through your trades, start to identify trends. In the same way that you'll have trends in your trades and trends in markets, there will be trends in your own trading. Because when we get to step 10, well, what we want to do is repeat. As we're building records, okay, and reviewing them, we want to start being able to repeat the trades that work for us, the trades that, that work with us, and then cut out the sort of sloppy, impulsive, poor trades, okay, which all humans make, which all individuals on a trading journey will make. But if we can identify those and start to cut them down whilst looking to repeat the trades that work best for you, well, then we're in a position of evolving and developing as a trader and as a trading business. So there's 10 steps there, okay? They are, what's the word? They don't cover every single element, okay? But as a starting framework, if you're doing all of those 10 steps, well, then you're putting yourself on the right side of the market, all right? And you're building a routine. You're building that consistency and discipline. And that's what will take you furthest in your trading journey. And, we've talked about, what instruments should we focus on, and what we've looked at is, a broad spread generally. So in the FX pairs, we've got the dollar index and the 28 major crosses between the majors and the minors. We've had a look at the major global indices, the major global commodities like oil, gold, silver. Some people like to trade, the equities, and in particular things like the US tech stocks. So, Nvidia came out yesterday, Facebook, Amazon, Apple, etc. And some people will want to trade crypto. The good thing about price action is that it works across all time frames and all instruments. And that might appear like quite a large watch list to begin with, but the whole idea is that with time and a bit of practice, what will happen is you will probably sort of reduce your focus to maybe 2 to 6 trades, okay, instruments. That's what normally I find tends to happen with traders. But we start, and then actually as you start to focus in, as you work on being the best trader you can be. So there we go. There's a little bit of an introduction there, and I go through that every week because as I said, I want you to hear the good, strong, same messages every week. I want you to basically almost like osmosis. The more you listen to it, the more it seeps in and becomes the way you look to operate as a trader. But what we want to be doing is looking at how to trade a 3-bar reversal with price action. So firstly, well, what is a 3-bar reversal? And the clue's in the name. Not unsurprisingly, it is a trade setup that is created over 3 bars, okay? So that shouldn't really be much of a shock to you, ladies and gentlemen. But I like to think of it as almost kind of like a mechanical trade setup, which for new traders can actually help enormously. I always say that it is time frame and instrument agnostic, meaning that you will see these set up across all time frames and all instruments. Today, we'll kind of a little bit of focus on the FX markets and the explanation, but then we'll have a look on the indices markets when we go to the live charts, because there was a few setups there this morning for it, and I think it always helps to be able to see it in the live market. What we're interested in is the location of where this 3-bar setup, okay, whether it creates the real conditions for a trade or not. And that's what we're going to go into in a little bit more depth and a little bit more insight, so to help you understand it for your own. So let's start to talk about the setup. If you're a swing trader, you will find these 3-bar reversals. They will set up on the weekly, the daily, and the 4-hourly charts. If you're an intraday trader, you'll find that they will set up on the 60, the 30, the 50, and the 5 minutes. They will set up on the 1 minute charts, but for new traders, things are happening probably a bit too fast. Okay, things are happening a bit too fast. All right. So my suggestion is, the 5 minute. No, don't be going lower than 5 minutes to begin with until you've got a little bit of experience. In terms of the chart setup, well, the chart setup is just the same as you will see across all of the charts that I tried to put on. Very, very simple. I have some simple moving averages, a blue 20, a red 50, and a green 200. And this is what helps us, because when they're in alignment, that sort of defines, that's almost like a filter for the trading environment we're looking for. So when I see prices above the 20 and the 50 in particular, then I'm happy that we have a filter for if we're in a long environment. I'm looking for buys. And when price is below the 20, which is below the 50, well, then actually what I have now is a filter because I'm only looking for sells in that particular environment. That's a short environment. And you know, it's just a simple filter, but what it does is it helps me sort of try to get in line with, you know, with where there might be possible trends either starting or continuing. And that's where I want to do my business. So let's bring this up. Okay. Step one. Okay. Step one, define, is there a trend? Okay. Is there a trend? And we can utilize that, as I said, using just simple price structure and a moving average fan. Price structure, you know, making higher highs, higher lows, lower highs, etc. Just, you know, as we would look at in terms of price structure. But if let's just go up the old drawing tool. Boom, boom, boom. Okay. What I want to see is, you know, let's say for a long, okay, for a bullish environment, price should be above the 20 period moving average, which is the blue, which should be above the 50. Okay, so we've got price, the 20, the 50. That is helping to define an uptrend. So that is the filter that defines that we're in a bullish environment. I'm only going to be looking for longs. And then what I'm looking for is I'm looking for a pullback to be able to enter the long. So as the price is moving up, it pulls back. And then this is what I'm looking to do. I'm looking to find a space to get in here to basically get a piece of the next journey. Okay, that's what we're looking for. Step two, okay. In an uptrend, you know, so price is above the 20, which is above the 50, price retraces towards support. Now, that support can be defined by either being what they'd call dynamic support resistance or dynamic support in this case. So that could be like a moving average, or it might be static, okay, or it might be static in terms of things like a level of support resistance that we drew on in step one of our overall plan, or maybe it's a big round number, okay, something like 2000 in gold, etc. Generally, what I sort of suggest to new traders is, in particular, look for kind of a pullback to the 20 period moving average. Okay, that's your first point. If you can find a pullback to the 20 period moving average, that is a nice starting way to interpret this particular trade setup. So, as we can see here, price has been an uptrend. It's above the 20, it's above the 50, and actually what we can see is price starts to pull back. And where does it pull back to? It pulls back to the blue 20 period moving average. This is where I start to get interested. Here we go. Step 3. At support, okay, if we have two seller bars, okay, two red bars, followed by a green buyer bar, then we are looking to trade in the direction of the overall trend, okay? So we need 3 bars, 2 seller bars. So here we go. In this case, we've got 1 seller bar, 2 seller bar, followed by this 3rd buyer bar. Then we are looking to take a trade in the direction of the overall trend, and the trend, okay, the major trend is bullish. We are looking this is a pullback. This is a chance for us to basically re-engage, okay, and be ready to sort of trade in the direction of the dominance trend. So the simplistic view is, at the 20 period moving average, look for 2 red bars followed by a green bar. Okay, that's what you can do. If you were boiling this down to the most simplistic basic elements. However, what I would say, even though we're looking for 2 red bars followed by a green bar, personally, I find that if that green buyer bar is something like a pin bar, which in this particular case, that case there, 1, 2, 3, okay, that is, it's a green buyer bar, but it is also, a bullish pin bar. Or maybe it's an engulfing candle, or maybe it's an inside bar, or maybe it's a spinning top. If the green buyer bar is also one of those, and actually, if it closes back above the 20 period moving average, well, then this gives us more confidence. Okay, that gives us more confidence. It doesn't have to. Okay, it doesn't actually have to be one of those candles. It doesn't have to close back above the 20 period moving average. But I have found, especially for new traders as well, if you find those trades that set up like that, well, then it's just giving you a little bit of confidence. It's just making it a very simple. It's almost making it a kind of a mechanical setup. Okay, step 1, price is above the 20, it's above the 50. Step 2, price pulls back to the 20 period moving average. Step 3, I see that there are 2 seller bars followed by a green bar. Step 4, okay, that could be, our move. But as I said, if the green buy bar happens to be a pin bar, an engulfing candle, an inside bar, a spinning top, a doji, that makes me happy. And if it closes back above the 20, that also gives me confidence, because that's giving me a hint that the dominant trend is getting ready to re-exert itself. And of course, I want to be part of that. So, in a long setup, what we're looking to do is step 4 is, how we're going to enter. Now, today, I'm just going to talk about the standard setup, okay, so that new traders can take it away and work with that. Those of you who have a little bit of experience, okay, there are aggressive ways to enter this. There are aggressive ways to manage this, but today, we're just going to focus on the standard setup. And the standard setup is, we look to enter 1 pip plus the spread above the high of the buyer bar. Okay, just 1 pip plus the spread. Our stop loss, okay, is 2 pips beneath the low of the 3 bars. Okay, and it's important to say the 3 bars. Most of the time, you're going to find that bar 3 is the lowest, but not always. And you'll see that even on a few of the examples, from this morning. So we know where we're entering. We know where we're getting out if we're wrong with our stop loss. And now we want to know is, well, where is our target? Step 7, reward. Our target is 1.5 times our trade risk. What does that mean for new traders? Well, if I've worked out what my entry level is, and I've worked out my stop loss level is, that's my trade risk. So let's say, I don't know, maybe say for an example, maybe our trade risk is 30 pips or 30 points. Well, if it's 30 points, our trade risk, my target is going to be 45 pips. Okay, it's going to be 1.5 times the trade risk. Okay, I probably should have a little multiplication there. 1.5 times our trade risk. Okay, so probably around about up there. Okay, that's what we're looking for. So, we know where we're entering. We know where we're getting out if we're wrong. We know where we're getting out if the trade is fortunate enough to be right. Okay, so it's almost mechanical. It's almost like you could almost, in a way, sort of set and forget if that was the kind of style of trading you liked. And then here's a couple of little simple trade management rules just to help you. And this is just born out of experience. The trade management. If the trade has not triggered after 3 candles, then take it off. If it's not triggered after 3 sessions, take it off. Because what we're looking to do, remember, is we've identified there's a trend. We've identified there's a pullback. And what we're expecting is another shove, okay, another move, the dominant trend to re-exert after the pullback. If it hasn't, and actually it hasn't triggered because price has just basically been, drifting sideways or drifting down, well, then that is not really where we want to be. Okay, so if the trade hasn't triggered after 3 candles, and so if let's say you were looking for this setup on weekly charts, after three weekly candles, if it still hasn't triggered, take the trade off. All right. Furthermore, for the standard entry, if price continues and then closes below the low of the 3 bars before it is triggered, and take it off. And what do I mean by that? Well, once again, let's just say, just for the moment, just ignore that price action there. Price action is here triggered. We've put our order in, and actually what's happened is price has just basically continued down, all right, and actually is closed beneath the low of the 3 candles. If it's done that, the reality is that once again, the sort of the re-emergence of the dominant trend has not happened. Price probably is just looking like it needs to pull back again more, in which case our trade setup, it's not really valid. The other important thing is, which is sometimes what new traders struggle with, is once the trade is triggered, let the trade play out. Okay, so in this case, once the trade is triggered, let the trade play out. Okay, either flies or it dies. Let the trade play out. So this is actually not only a good trade setup, but it is also a great exercise in terms of discipline. Okay, being able to just stick to the rules and let the trade play out, not interfere, not sort of grabbing at profits. Okay, and not moving stop losses further apart. Okay, just it's a good exercise for building discipline as a trader as well. And what I suggest to people is, when you look at a trade setup, make a commitment to do 20 of these trades, okay? Then look to evaluate. Now, for the standard trader, generally what we see is there's a kind of a win ratio between about 48 to 58%. Sometimes it can be a little bit higher, sometimes it can be a bit lower, but as a general rule, it's in that zone, okay? It's in that zone, and that will differ a little bit depending on what you trade and the time frames, but as a general rule, that's what we're looking at. I have to think, for those of you advanced traders, you have to work out, well, if you've got let's say if you've got a hit rate of, just 48 to 58%, and then also you've got a trade a reward to risk ratio of 1.5%, well, hopefully you should be able to realize that, that does give you positive expectancy, which if you're a completely new trader, that might sort of just be a concept that's just a little bit coming down the line for you just a little bit. But what we want to do is that, we want to be able to ensure that if we're going to have a strategy, that it actually does have an edge that, an edge that will take us places in the markets. So Lalit says, and I do apologize if I pronounced your name on what happens if entry is achieved on bar 4 and not bar 3? Well, that's absolutely fine. In terms of if you've got here bar 1, 2, here this is excuse me, just bar 1, bar 2, and we've identified bar 3, and we've set our order, and then actually maybe the next bar doesn't go, but the bar after it does make the move and triggers you in. That's fine. Remember what I was saying is that if it hasn't triggered after 3 bars after you've set it, well then take the trade off, okay? But it might well be that then this candle just goes sideways, and then it basically the next bar, it actually shoots itself up. That's absolutely fine. So on the short side, okay, it's reversed for selling opportunities, okay? So in which case now what you're looking for is price has to be beneath the 20, which is beneath the 50, and then price pulls back. And actually what we're looking for is 2 buyer bars followed by a red seller bar, preferably at resistance, okay? So as I said, start off with a kind of dynamic resistance at something like the 20 period moving average, so 2 green bars followed by a red bar, or 2 green bars followed by a red bar. That one's one bounced off the 50 here. 2 green bars followed by a red bar before the price moved its way down, okay? And we'll have a little look at a few more examples in a moment. So it's just flipping, it's reversing, okay, what we're actually particularly looking for. So what I've done here is I've put in all sorts of examples here from all sorts of instruments, all sorts of time frames, okay, over the last few years to show that this is just a simple, solid setup that occurs constantly in markets, okay, that and this is what we're particularly looking for. So this is actually a euro-yen weekly chart. We can see price, you can see price in a downtrend. Price is beneath the 20, which is beneath the 50, and then price pulls back here, doesn't it? There's the first green bar, there's the second green bar, and then we get the third bar, which is a seller's bar. And not only that, it's an inside bar as well. Remember what I was saying is that if in this case, if the third bar is like an inside bar, that gives us more confidence. Our entry is beneath the low or stop. Remember, our stop is above the high of the 3 candles, which in this case, the high of 2 is higher than 3. And then your trade is 1.5. Okay, 1.5. Your target is 1.5 times your trade risk. Now, it just for those of you smart Alex, you might actually see, well, in many ways, this could actually be seen as a setup here, because you've got 2 green candles followed by the third candle, which is the third bar, which is it's a bearish candle. The reason we wouldn't take this is just look at the size of that candle, okay? If we look at candle 3 here, that is it's a nice sized candle, okay? Which means that in order to achieve our reward to risk, okay, we've got a better chance. Whereas actually this here, if we're shorting here and we're our stop loss here on a weekly chart, that would mean that price would need to move considerable distance to hit our target. Now, actually, we can see that it actually did that. All right, it did actually do that. But you don't know that, all right? You don't know that when you put the trade on, all right? And what I'm saying is for me, the trade risk then starts to become far too big, okay? And that's why I wouldn't be looking to trade that as opposed to this one, which would be is far more suitable. And we'll look at that today on some of the live opportunities on the indices this morning. This is one from, yes, it's from a few years ago, but the reason is it's just to show you this was the Australian dollar against the US dollar. It's a daily chart. You can see price has been beneath the 20, which is beneath the 50, and this was a whole summer where we had effectively Australian dollar weakness and US dollar strength, and every time price pulled back, in a 3-bar reversal. Okay, every time price pulled back, it did a 3-bar reversal. 2 green bars followed by a red bar, and it dropped down. Now, of course, some of these are more suitable setups than other, but I just wanted to be able to show that sometimes this is what happens in a good strong trend. This is what may well occur, that you get a good strong trend, and the pullbacks, those pullbacks are ended by a 3-bar reversal, and that's an opportunity. And as I said, I'm just showing you lots of different examples from different time frames, different instruments, over the last good few years, to show that this is it's a setup that repeats and works, and is something that you can actually utilize in your own trading. Even at Facebook, okay, this is the weekly chart of Facebook. Okay, price was above the 20, is above the 50, and every time it basically put back. Okay, most of the times there were a form of a 3-bar reversal. Okay, some of them much better than others. Okay, in terms of looking at the price action, but in terms of meeting the criteria, in terms of the filters there, then the actual setups there, that happened. Okay, and as I said, it's a setup that occurs across all time frames and all instruments. It's just having a little bit of sometimes the patience to wait for the particular setup. And at the other end of it, okay, the Dow Jones 15-minute chart. Okay, you can see price is above the 20, which is above the 50. Price pulls back to the 20, doesn't it? We've got 1 bar, we've got 2 red bars, followed by a third green, which is a buyer bar. It's also a bullish pin bar, and price moved, and it sets up again. Price came back down. In this case, it was just a little bit above the 20, but it was also the sort of yesterday's high, and it came down and put in a very strong, bullish candle before it moved. All right, and that's, as I said, there's just lots of examples in here. Gold on the weekly chart. Okay, price has been beneath the 20, it's been beneath the 50, it's been in a downtrend, pulls back, 3-bar reversal, pulls back, 3-bar reversal, 2 buy bars followed by a seller bar, bang, pulls back, 2 buy bars followed by a seller bar, pulls back, 2 buy bars followed by a seller bar, pulls back, 2 buyer bars followed by a seller bar. And as I said, some of them are better than others. So if we look at this last one here of the 50-period moving average, that's a nice inside bar, isn't it? So your stop would be above the high of the 3 candles below there, but actually there's a particular move that sets up there. And so, as I said, I just want to show lots of different examples, lots of different ways, lots of different time frames to show you that once you practice working on this and seeing this, okay, it starts to become much easier for you to be able to recognize pound against yen, 4-hour chart, price is above the 20, it's above the 50, it pulls back, bang, 2 red seller bars followed by a green buyer bar, which is also a pin bar, and price makes its move. Okay, 1.5 times our trade risk. That's what we're particularly looking to do. This is quite mechanical. This is not us looking to generate some super duper 10-hour trade. Okay, this is almost like a bread and butter setup. Okay, the one that you can just work with and utilize time after time after time. Deutsche Bank, okay, Deutsche Bank on the daily charts there. Okay, price is going sideways for a moment. When it's doing that, we're not really interested in it too much, but we see price gets beneath the 20, which is beneath the 50. Price pulls back. Okay, 2 buy bars followed by a third seller bar, which is also very strong. Rejection candle, domino candle, away it goes. Price pulls back, puts in a 3-bar reversal. The chances are you might well have been triggered out on that, okay, depending on where your stop was, but the setup is valid. Price moves down, pulls back again, 3-bar reversal, 2 buyers followed by a third bearish candle, bang, and it does that, okay, in good trend as that trend is steepening and moving away. The DAX 5-minute chart, and it's just to show that in this particular example, price was clearly beneath the 20 and the 50, and what we could see is here price pulls back, 2 buyer bars followed by a seller bar, which is also a pin bar. Price moves down, comes up, inside bar, moves down, comes up back, 3-bar reversal, comes back, 3-bar reversal. Okay, and you know, when there's good trends, you might find that there are quite a few like that. I'm just going to show you some examples from this morning. Okay, when there's good, nice, steady trends like that, there will be opportunities, and you know, and that's that. You know, it's just having the patience to wait for them. 15-minute chart on the DAX. I'm hoping you're kind of seeing that, you know, price is beneath the 20, beneath the 50. Price pulled back. 2 buyer bars followed by a, you know, very small, okay, spinning top, third seller bar, and that moves. It comes, sets up again, okay, and it moves, comes back, sets up again. I think you'd be a little nervous, but you'd probably be still in. Okay, remember our stops, okay, is just above there with the spread included. All right, but you know, that's what we're looking for, okay, in terms of just into a trend, price pulling back. And you know, as I said, even if you just start looking at how price reacts around the 20 period moving average and then maybe the 50, okay, as a starting point for new traders, that's a good place to operate. Even on such charts as things like as the dollar index and the monthly chart, price had been above the 20, which is above the 50. Price pulls back, okay, puts in 1 seller's bar, 2 seller's bar, and then we get a 3rd bar, which is a buyer's bar. Not only is it an engulfing candle, but it also closes above the 20 as well. Remember, I was saying I like to see that, and then really for the next year, price basically in the dollar index rose higher, and that's what that's the kind of thing we're looking for. So, in conclusion, all right, the 3-bar reversal, it's a simple mechanical pullback trading tactic, but it works best in a good trend, and so we define it as if there is a trend. We use that simple filter. If price is above the 20, which is above the 50, well, we're in a bullish environment and we're just looking for buys, okay, on pullbacks. If it's the flip, whereas price is beneath the 20, which is beneath the 50, we're looking for sells on pullbacks, so, you know, rallies into resistance. So we define if there's a trend. We wait to see if there's a pullback to support in an uptrend or resistance in a downtrend. You know, if we're in a bullish environment and we're looking for a long, we'll buy. We need 2 seller bars followed by a buyer bar. And for a short, okay, for a downtrend, price pulls back, price rallies, we're looking for 2 buyer bars followed by a seller bar. Now, if that 3rd bar is something like, you know, it's a pin bar or it's an engulfing candle or a spinning top, okay, key reversal, etc., and also climbs back above the 20 period moving average in the direction of the main trend, well, then invariably that gives us more confidence as well. So, you know, today we've just talked about the standard entry, and that's the standard entry. Standard entry, you know, for a buy is basically, you know, 1 pip plus the spread above. Stop loss 2 pips beneath the low of the 3 bars. Okay, the target is 1.5 times our trade risk, and we can almost set and forget the trade. Okay, let the trade play out. We're just utilizing a very simple standard target. So, in conclusion, all right, price action is just, you know, it's just a simple way of analyzing markets using price movement over time. We are always looking for price action triggers at significant price levels or zones, and that's what allows us to build a very simple price action trading plan. The 3-bar reversal, okay, that we've just shown there, it's a very simple mechanical pullback trading tactic utilizing some of the price action elements that we have talked about so far. What's important is to define where that 3-bar reversal occurs, and I'll show you some live examples of that at the moment. What we're looking to do is we need it to occur as part of a pullback that is in a clear trend at a suitable level of support or resistance. As I said, to begin with, even if you just focus at looking at it off the 20 period moving average, all right, and then maybe added the other 50 and the 200, maybe added, and then you could add things like previous day's highs or lows. You could add big round numbers, etc. But just to start with, you could just work it like that. Provides us that confluence of events. You'll have heard me talking about it plenty of times. Confluence of events, okay? 2, 3, 4 things coming together at one time and place that gives us a better probability of a move in the direction we're looking for. And as I said, it can be used across all instruments and all time frames. There are some that are suitable, better than others, but you will see the setup. Once you practice looking for it, you will see the setup everywhere. Okay, once you've got that cognitive recognition of being able to see it, and then it becomes about, you know, choosing the best setups based upon, as I said, that kind of that bigger picture, the context that we find going on. So why don't we have a little look at them on live markets? Let's switch across to the charts. Before we do that, just a reminder that don't forget to join us next time Okay, and our next session is on Wednesday, 30th of August. It's not Friday, but Wednesday, 30th of August, session 48, how to improve your price action trading plan, part 3. So we've done a couple of parts. I said I'd do a few over the summer period, okay, just on things you can do just to tweak and improve your price action trading plan. And so we'll do the third one there. And what we'll do is we'll do a little quick recap of parts 1 and 2. We'll look at the importance of improving your plan and how you can utilize it and how to use your price action charts accordingly to make yourself more efficient as a trader. And that'll be, as I said, next Wednesday. All right, next Wednesday, 30th of August. Check your inbox for the webinar link or go onto the website, okay, to sign up. And if you've got any questions or comments, by all means, you can see there, you can contact us. There's a whole host of ways that you can get in touch. And what you will find is that, if you've got any thoughts or comments, or if there's something you'd like to see me cover in terms of price action, please, you'll find that we appreciate and enjoy the feedback. You'll probably be sent a form just straight after this. We'd appreciate if you take the 30 seconds just to fill that in. But as I said, if you've got any other comments, you're very welcome to sort of send those in, and we'll happily take that on board. Okay, so just bear with me one moment. What we'll do is we'll switch across to the live charts. We've got a couple of minutes left and stuff, so we'll do that and we'll have a little look at what's going on. So just bear with me for a moment, ladies and gentlemen, and we will switch across. Okay, let's fabulous. So I am hoping that you can still see me. I'm hoping that you can still hear me, and I'm hoping you can now see the Admirals Metatrader platform. Let's just move this a little bit around here. What I've got here is I've got a profile on indices. So, for a lot of the examples, we looked at FX pairs, okay, but what I thought for the live example would look at a few indices. I want to show that, we can see it across all time frames, all instruments, but also because this is, the end of August, the markets can sometimes be a little bit quiet when looking for opportunities, but actually this morning on indices was not the case. So I'm just going to show you a couple of examples on a sort of intraday time. So let's start with the FTSE this morning. Okay, the 5-minute chart on the FTSE, and that's what we have here. Okay, I'm hoping that, as I said, that you can see me, hear me, and see the chart. This is just 5-minute chart FTSE. Okay, the grey box here is my kind of sessions indicator. This is in terms of coming out of the Asian session. We're coming into the start of the UK session. What are we looking at? Okay, in terms of price is above the 20, isn't it? Which is above the 50. So we have the filter. We're into a bullish environment, and what do we see is price pushes up, and then what does it do? It pulls back. Okay, we get 2 seller bars followed by a third buyer bar. Now this bar is it's a bigger candle than normal, but we like the fact that it's a rejection candle, and also what does it do? Closes just above the closes back above the 20 period moving average. That trend is looking to exert itself, and we can see that basically that's what it does. And then price pulls back again. And we get 2 seller bars. Okay, followed by a green buyer bar. Now, the interesting one, this is an interesting example, because what we've got is it's actually bar 2 that is a rejection candle. Okay, it's rejecting the candle, and it's bar 3 which closes back above the 20. Okay, it's the bullish candle. It closes back above also the previous candle, and that becomes our 3-bar reversal. So what do? We look to basically buy 1 pip above the high plus the spread with our stop beneath the lowest of the 3 candles, which in this case is candle 2, and you can see the price basically moves its way off there. What we have here is there's actually there's an example here and there's an example here. Okay, 2 seller bars followed by a third bullish buyer bar. But what I was saying, remember what I was saying is that we like to see it actually come back to a level of support. And as I said, to start with, maybe just look at the 20 period moving average. And when prices started to go parabolic and started to go vertical, I'm always wary about sort of joining that. Okay, so in this particular case, you can actually see that it actually worked out very, very well. But once again, you don't know that at the time. It's the same here, okay? And that we get 2 seller bars followed by a buyer bar, but we haven't, we're almost like we're wafting away in the higher atmosphere. Okay, I like to see us, as I said, at the kind of at a significant level of support that is very clear, that we can see that price is bouncing off. Okay, that's where the ideal trade opportunities. But as I said, that's just this morning. Okay, on the 5-minute chart, you can just see there's a couple of good examples and a couple of examples that make it and actually do it. But as I said, part of it is we want to pull back to a level of support. That's where the best opportunities are to be found. And interestingly, we saw very similar price action there this morning on the US indices. So let's do the S&P 500. Okay, here's the S&P 500 on the 5-minute chart this morning, and hopefully what you can see is that once again, coming out of the Asia session, price is above the 20, which is above the 50, and then what we see is very nice setups. Okay, price pulls back, puts in a 3-bar reversal. The 3rd bar is also a nice bullish pin bar, and away it goes. Okay, you have to set and forget. It actually comes back and sets up again before it moves. Hopefully you can see it sets up again. There's 2 seller bars followed by a 3rd buyer bar, okay, which is a nice candle closing back above the 20, back up above the high of the previous candle. Away it goes. We actually start getting this one here, which is once again, this is a very big candle. Okay, and actually it does make the target, but you don't know them. Remember what I was saying about how what we want is ideally we like kind of smaller candles, smaller setups, so our trade risk is smaller. If our trade risk is smaller, the likelihood of achieving our 1.5 reward to risk target improves. Okay, but there's actually a couple there, as you can probably see there before. There's another 1, 2, 3, before price, hammers its way up on there. This is Lalit is asking what the time frame is. This is the 5-minute chart. Okay, this was the 5-minute chart on the S&P this morning. That was as was the FTSE, and also actually the Nasdaq this morning. The Nasdaq here this morning was doing exactly the same. It's clearly a morning for it on the indices, out of the Asian range, price above the 20 and above the 50 as we come into the European session, and then price pulls back. Okay, hopefully you can see price pulls back, and there's 1, 2, 3. Okay, another 2 here. As I said, these are starting to get very big. Okay, these are starting to get very big indeed on the Nasdaq. But at the start of the session, okay, there was a couple of nice setups there. Just literally, as I said, these setups, they will appear across all time frames, across all instruments. It's just having the patience, okay? And if you're an intraday trader, as I said, the 5-minute, 15-minute chart, you can see these, okay? Just have to have the patience to watch and see if it develops. And that's why we have that filter to begin with. Now, we just use the filter. Is price above the 20? Is above the 50? Okay, that's a bullish. Is price beneath the 20, which is beneath the 50? That's a filter for the sort of to only want to sell. So that means we can filter in or out the instruments that we look at very quickly, because if they're not achieving that first filter, well, then actually there's no trade for us at all. Cool. Hope that answered your question there. Unfortunately, as always, time flies and such. So Lalit says, would you trade the Nasdaq after 8 a.m. UK time, even though it doesn't open until 2:30? That's a very good question. If you'd asked me that question 5 years ago, Lalit, I would have agreed with you and said, no, don't trade the US indices in the morning. Okay, trade the European indices in the morning and the US indices in the afternoon if you're based in European time frames. But I would suggest that really, in fact, since the time of COVID, the last few years, okay, last 2-3 years, you will have seen there has been a huge uptick in the volume and volatility of those, let's say, electronic traders trading the US indices in the European session. And so these days, I would say yes, you can actually trade it then. 5 years ago, I would have said avoid it. Okay, but markets evolve and change. Okay, and if you look at the price action in the morning on a lot of those US indices, it's not massively dissimilar to DAX and FTSE. Okay, occasionally there's a divergence if there's like local European news, but the price action is there, and it is tradable. But that's a very good question. I hope that helps you there with that. Okay, ladies and gentlemen. So unfortunately, as always, time flies when you're having fun. We've run out of our time. I've tried to always try and cram in as much as I can to help you as much as I can. And so we're always flying through, and I do appreciate that. That's why these sessions are recorded. You can go back, you can watch them at a bit of a slow, or you can go back through the elements, because I'm trying to always try and get as much as I can across to you in the time that we have together. But I hope you found that useful, ladies and gentlemen. I hope that's given you a little bit of insight into a very, very simple mechanical trading tactic, okay, that you can take away and that you can utilize. And hopefully you can see, we just looked up what was there this morning, and I've shared lots of examples of different time frames, different instruments. Once you learn how to do it, you'll recognize, the better setups, okay, in terms of just waiting for a bounce off the 20-period moving average or one of the other moving averages. That's a really good, simple way to keep it kind of mechanical for those new traders. And as always, I wish you the very best of success in your own trading. Hope you'll join us next Wednesday, 30th of August, where we're going to be having another look at refining your price action trading plan. And until then, ladies and gentlemen, trade well, and I will speak to you soon. Take care, everybody. Cheers.